And this is the Business Breakfast. Time to talk to Jeff Rhodes, the CEO of International Commodities. Very good morning to you, Jeff.
Good morning, Malcolm. How are you?
Very well, thanks. Thanks for joining us. I was saying just before the break there that it's been a pretty exciting summer for gold. It has dropped back a bit. I'm seeing the current price is $1,782 an ounce. That's way off its highs of 1920 and quite a bit off yesterday morning even, which was up at 1820. So a bit of a fall. Is this a temporary blip, do you think, for gold?
Well, it's interesting, actually, Malcolm. Typically, you see a summer weakness and the markets start to rally and look a bit stronger as we head into the fourth quarter of the year. But it could well be this is the year where it just acts completely differently. As you say, we've seen record highs, both 1912 and 1920 in August. But it's looking soft, and technically, it's at a key level, Malcolm. We're currently just hovering above the 40-day moving average, which is now located at around 1775. If we see the market close below that level, I think we're on for a much weaker period, and we could even see the price dip towards maybe as low as 1650, 1660. Certainly, there's enough in this market that would tell me to urge caution. You know that over the last 2 years I've been bullish, I've been looking for higher prices, but I think now I really believe that investors should just kind of take a deep breath, stand to one side. I think that we could be in for lower prices over the next month or so.
Well, I was reading an article yesterday on the way central banks influence the gold price, not necessarily intentionally. For instance, when the Federal Reserve increases money supply by 1%, gold prices increase by 0.94% on average. We could be in for an increase in the money supply this week in the States. I mean, don't you think that'll give some fillip to the gold price?
It would do, yeah. Certainly, when QE2 was announced in the US, we saw a rally. I mean, the rally to 1920 really started from around about 1400, Malcolm. So a $500 rally on the back of QE2, if we see the equivalent QE3 and so on. Yes, I do think that could change the picture, but it's feeling, the market feels a bit tired to me. It's really interesting. Whenever we've seen equity markets come under pressure and a move into safe haven, over the summer that safe haven investor move has been into gold. Over the last week we've seen that move into the dollar and into US treasuries. And so I think there's a degree of uncertainty in the world in all asset classes, and it looks to me as though money managers are moving into cash, and dollar cash at that. There's concern about the Eurozone. There's been a cap really put on the Swiss franc and so on. So I do feel that for some reason or another, that we're in for a period of weakness, and that if there is safe haven buying, it's going to be in the US dollar. And of course, the US dollar does make it, stronger US dollar does make it very difficult for dollar price commodities, particularly gold.
Talk about the volatility for a second, Jeff. One of gold's great strengths, really, over the last couple of years has been that despite its rapid ascent in price, the market has remained pretty orderly, and volatility has been relatively low. But that's all changed over the summer. I mean, since it hit that 1920 figure, gold's been lurching one way and another, pretty violent swings. It's a hard market for anyone but the most hardened goldies to follow.
So even the most hardened goldies are finding it difficult, Malcolm. And I think you've made a great point. Although we've seen, look, we've got a 10-year bull market, and certainly that's accelerated over the last 2 or 3 years. Despite that, option volatility, as measured by at-the-money short-term volatility, the amount that traders expect the price to move by, and that's been hovering around 15%, quite average, quite normal. In the last month, that's been up as high as 35%. So the option volatility market is really highlighting the extreme movements in price we've seen over the summer. It's almost become standard to see gold up or down $100. And and even the best professionals in the market find that difficult to live with. And many would argue that this kind of extreme movement in price, erratic volatility, is the signal of the end of a trend. And maybe we're coming close to that. I think not. I think that although I'm looking for a period of consolidation, maybe as low as 1700, 1650, I still see that as a chance to buy with a price north of 2000. Widely predicted for 2012.
Well, that's right. I mean, UBS, for instance, have recently raised their forecast for the average 2012 price from $1,380 to $2,075. HSBC has lifted its prediction for the average price for next year from $1,625 to $2,025. That must tell you something.
It does, and currently there's a gold, the world's leading gold conference is taking place in Montreal at the moment, the LBMA Gold Conference. The move from that seems to be universally bullish, and the CEO of Anglo Gold Ashanti, one of the biggest gold mining companies in the world, is actually looking for a price of 2,200 next year. And just to remind everyone that if we go back to January 1980, when the high gold was 850, if we inflation adjust that forward to today, that gives you a gold price of around $2,400 to $2,500 an ounce. So certainly still a lot of room on the upside. But timing is everything in markets, and I just think you're going to get a chance to buy cheaper.
Just talk about the LBMA meeting. I know you often go to the London Bullion Market Association meeting, which is being held in Montreal. Which I like the principle of the London Bullion Market being held in Montreal, because it opens the possibility for the Dubai Eye Business Breakfast to be held in Honolulu, which I think is a nice move. But the LBMA chairman, David Gornall, told Reuters on Sunday that conflict gold is an important issue for this meeting of the great and good in the precious metals world. He said, "We will issue guidance on conflict gold due diligence so that it is practical for the refiners and credible for the outside world." Now, conflict gold, Jeff, I mean, you're going to have to explain. I've heard of blood diamonds, but not conflict gold.
Well, yeah, you've got it in one. It's the equivalent. There's a new law coming into force in the US called Dodd-Frank's, and one of the aspects of that is the prohibition of the use of conflict minerals, i.e. minerals such as gold, for example, coming from the DRC in Africa, Democratic Republic of Congo. Now, this law will prohibit the use or make it necessary for you to state if you're using materials, minerals, or in this case gold from the DRC, you have to state that. And of course that's definitely not allowed. So because of Dodd-Frank, it's going to be a big issue for the world of gold, because of course Africa is the source of a large amount of the gold that's produced in the world. And you just have to be really sure of where your gold is coming from. You cannot participate or be allowed to buy conflict gold, which is gold coming from a war-torn area such as the DRC. And so the efforts of the LBMA with the gold refiners and with the market is to ensure you have the right due diligence, you know where that gold has come from, and that you don't get involved in conflict gold, which is the equivalent of blood diamonds, which people will be very well aware of. And definitely, for example, in Dubai, the DMCC is a big supporter of not being involved with conflict gold, and definitely the refineries that operate in this part of the world have very strict rules about what it does and where it sources gold from, and it ensures that it doesn't get involved in processing gold that's come from places such as DRC.
I'm sure we'll be talking about that in the future. Now, just one finally and very briefly, Jeff, trading of Dubai Gold Securities, DGS, on Nasdaq Dubai was up at over 6,000 securities in August of this year. That's a 230% increase from July, and that's up from the 636 that were traded in the whole of the first half of the year. Who started suddenly buying these gold securities on Nasdaq Dubai?
Well, I just think, I really wouldn't like to comment on individual investors or where investment is coming from, but it highlights the level of investor interest in gold, and certainly in exchange-traded products such as that, which gives you an equity that's backed by gold. And many investment funds are allowed to invest in equities, but not the underlying commodity. And so it is that kind of source of money that can come into equity markets rather than commodity markets. But having the hybrid of an ETF or an exchange-traded product that mimics something like gold is very popular, and I expect this to grow in this region.
Jeff Rhodes, the CEO of International Commodities, thank you very much for your time this morning. We look forward to talking to you next week.
Yeah, thanks, Malcolm.